Let's continue with the leverage discussion. So far we discussed about the leveraged business and we calculated their break-even point as 50,000 units at least, and everything about this level of production is going to give positive profits. Remember that their fixed costs were 60,000. Now the second case is the case of a conservative business. Well, here they just gave the more calculations, more information, but we already calculated our variable cost per unit and the price from total revenue and total variable cost. Now, a more conservative business, second case, chooses not to operate at high degrees of operating leverage, which in simple words means that they are more conservative. They don't want to borrow too much money to buy too much technology equipment, which is going to translate in higher fixed costs. So they would rather keep it slower growth, because this way they figure they reduce the possibility of loss too, but also the growth might be slower. And instead they rely more on variable cost, factory labor. So in this case, we are going to expect a smaller fixed cost and higher variable cost per unit. Factory labor is a variable cost. Let's see what we have here. Those are the units sold, total variable cost, fixed cost, 12,000. It's much lower than in the previous case. Remember, their fixed cost for the leveraged business was 60,000. For the conservative firm, it's just 12,000. So we are going to use the same formula. We know fixed cost, then we have to calculate price and variable cost per unit. Well, we do the same calculations. To calculate price, we are going to divide total revenue by units sold, 40,000 divided by 20,002. So the price is the same. Now, how much is going to be my variable cost per unit? Well, we divide total variable cost by units, 32,000 divided by 20,000. I believe this is 1.60 cents. Well, this is actually double than what it was in the previous case. Remember, in our previous case, the variable cost per unit was 80 cents. Now it's $1.60. The price is the same, but the fixed cost is much lower in this case. So now, finishing up the calculations, this conservative firm only has to produce 30,000 units to break even. Everything above this level of production is going to be profits, everything lower, loss. And this is how it looks in a visual graph. You see lower break-even point, 30,000 units. Everything above is going to make profits, but you see how you have a slower growth, not very aggressive. But you also limit the loss possibility because you only have to produce 30,000. So that was the case for the second conservative business. And the way businesses decide whether to go more aggressive or more conservative, it really depends on the economic conditions. Whenever the economy is doing well, it's booming, high economic growth, more and more businesses feel more confident to go more aggressive, because they are positive economic environments. Whenever there is a recession, they limit their risk taking. Competitive position within industry. If you are a leader, you may have more appetite for risk taking or more money, capital to invest. Future position. If you gain market power, even if you are not the leader right now, if you have been growing for the last few years and you have a good management, you might be tempted to take more risks. So you really have to analyze all these situations before you decide which path to take. And we have time in this video to work on an application on this leverage concept. Let's find one here on break-even analysis from chapter 5. This business has a fixed cost of 255,000 Let's make it a little bigger. It's on the small side. Let's see, where is our problem? Over here. So that's fixed cost. It sells its units for $66. This is my selling price per unit. I sell my product for $66 and variable cost per unit is $36. Compute a break-even point. Well, that's just the calculation. Fixed cost given 200,000 divide 255 divided by price minus variable cost per unit, which is contribution margin. So I'm gonna end up with 8,500 units to produce. Well, everything above 8,500 is going to give me a profit, everything below a loss. That's the interpretation. And of course, I want to be above. The business comes up with a new plan to cut fixed costs from 255 to 200,000. Well, that's kind of becoming more conservative when you lower your fixed cost. However, more labor will now be required. Yes, it's a trade-off, like we had in the second case, which will increase variable cost per unit to 39. So more variable cost per unit, less fixed cost. The sales price stays the same. What is the new break-even point? Now that we know that the business is becoming more conservative, we are going to expect a lower break-even point in units. We are going to do the calculations again. Break-even point, the new fixed cost, price the same, more variable cost per unit. So in this case, the business only has to produce 7,407 units. You see, less than in previous case to break even. And for C, under the new plan, cutting fixed costs, what is likely to happen to profitability compared to the old plan? Well, we discussed that whenever you go more conservative, like it happened, cut fixed costs, your profitability is going to increase at a slower pace, lower growth possibilities here. And this is what we have here. I'm going to continue with more applications on the break-even point and the leverage that we are going to move into next. And I'm also going to assign more applications like usual for you to work on.